Accounting Lessons for Special Accounts, Bank Reconciliation Statement. So here we try to give some explanations as to why we need a bank reconciliation statement. In this we have basically two entities. We have a trader and we have a bank. Trader normally maintains a cash book, and in bank they give us a passbook. So the trader can also be a customer of the bank. So this is the premises under which we actually work. Now trader has a cash book. What does it mean? Debiting cash book means money is going to the trader, and crediting cash book means money is paid by the trader. Now trader says cash book updates are always faster, since the trader, that is basically the trader, can do that immediately. Whereas the trader is also aware of the fact that the same trader, but if he is a customer of the bank, in bank the passbook updates take some time, since checks should be presented to the bank before anything can happen. Hence the statement in cash book and passbook need not match if it is taken on a monthly basis. So there is always a disparity between cash book and passbook, and that is why we actually need a bank reconciliation statement. Now let us see what is the state of affairs in cash book and passbook. Whenever there is a positive balance, it appears as a debit balance in cash book and a credit balance in passbook. Whenever there is an overdrawn balance, it appears as a debit balance in passbook and a credit balance in cash book. Now, what are the steps to be followed while preparing bank reconciliation statement? So, first step is find out when the abstracts of cash book and passbook are given. Next step is compare the cash book debit side with the passbook credit side, and the cash book credit side with the passbook debit side. The next step is whenever the periods of both abstracts are given in common, take into account only the uncommon entries. For example, the cash book abstract and passbook abstract is given for the entire month of January 2023, which would mean we will only take the uncommon entries between them for bank reconciliation purposes. When periods in the abstracts are uncommon, the cash book is given, let's say, for January 2023, and passbook abstract is given for February 2023. We'll take only the common entries and then create the bank reconciliation statement. We'll try to illustrate this concept with the help of an example here. Here what it is that the bank column of cash book of Mr. Kartak and the corresponding bank passbook of him is given. We are trying to prepare a bank reconciliation statement. The first thing which you have to notice is that this is actually for two periods. The cash book is given for March 97 and passbook is given for April 97. These are two different periods. So what is the rule? When it is for two different periods or uncommon, if the abstracts are uncommon, the cash book is given for January, that is, if it is uncommon, we will only take the common entries. So here we will try to see what are the common entries between cash book and passbook. We see that on March 97, that is 28th of March 1997, there is an entry to Dinshaw and Company. There is an entry for 2000 rupees. So that is also here in the passbook by Dinshaw and Company 2000. So also there is another entry on March 29th, 1997. There is an entry by Raju for 800 rupees, which is also figured in the bank passbook, which is on 2nd April 1997 to Raju 800 rupees. Now these are the common entries between the cash book and passbook abstract. So we have already figured that while we prepare the bank reconciliation statement, these common entries would be put in the bank reconciliation statement. Now let us closely examine what those entries are or the transactions are. So in cash book on 28th of March 1997, there is an entry for Dinshaw and Company for 2000 rupees. This is a debit entry, which means cash is coming to, or cash actually is collected by the trader. So if the cash is collected, since we are only considering the bank column of cash book, the insurer must have written a check. So that check, the trader must have gotten it on 28th March 1997. He immediately records it. That is why it is there in the cash book on March 28, 1997. But in passbook, it is not there. It's only appearing on 2nd April 1997. So we will say in the bank reconciliation statement, checks deposited but not credited. That is Dinsha and Company for rupees 2000. Similarly, on the credit entry of cash book, there is an entry for Raju for 800 rupees. There is a transaction. What does that mean? It means that the trader has given 800 rupees by means of a check because it is the bank column. And that is only recorded in the bank passbook of the trader on April 2nd, 1997 for 800. So we will put that under checks issued but not presented under Raju, which is 800 rupees. Now when we try to see the overdraft as per passbook, it is 0 because it tallies. Now there is a condition. There is a condition where it may not tally. If the final balance is actually negative, the starting balance is reversed and the overdraft will remain positive balance. That is also there in the bank reconciliation statement. So that covers basically an illustration of how to prepare bank reconciliation statement. Thank you.